Here's a simple way to understand the scariest trade in the stock market right now. Nvidia invests billions into OpenAI. OpenAI turns around and spends that money on cloud computing from Oracle. Oracle spends billions of that money buying chips from Nvidia. Meanwhile, Nvidia also owns a stake in CoreWeave, one of OpenAI's biggest infrastructure providers, and has agreed to buy over $6 billion of cloud capacity from CoreWeave through 2032. Follow the money around the loop, and it ends up back where it started. This is what's now called AI's circular economy. And it isn't a conspiracy theory, it's public record. Add it all up, and OpenAI alone has committed more than $1 trillion in infrastructure spending through 2035, spread across Oracle, Microsoft, Nvidia, AMD, Amazon, and CoreWeave. Microsoft has poured over $13 billion into OpenAI over the years. Nvidia contributed $30 billion into OpenAI's most recent funding round, which valued the company at $852 billion. And OpenAI remains one of Nvidia's single largest chip customers. Wall Street now estimates that more than $800 billion of this entire ecosystem is what's called circular financing, a small circle of companies investing in each other, then counting the resulting spending as real revenue growth. There's a name for what critics say this resembles: round tripping. It's when companies agree to buy from each other or invest in each other specifically to inflate reported revenue, without actually growing profits. It's the same basic playbook that powered the dot-com bubble in the late 90s, when telecom companies loaded each other up with vendor financing to buy each other's equipment right before half of them went bankrupt. And this isn't just theoretical risk. It already showed up in the market. Over a single week in late July, more than $1 trillion came off global chip and AI hardware stocks. The credit markets moved even faster than the stock market. CoreWeave's 5-year default insurance spiked to levels implying nearly a coin flip chance of default under standard pricing models. That's not a hypothetical worry. That's professional bond traders pricing in real doubt about whether these companies can pay their debts. And CoreWeave's own numbers back up the concern. The company's quarterly interest expense alone recently hit $640 million, annualized more than the entire company earned in all of 2025. Now, the people running these companies push back hard on the circular financing label. CoreWeave's CEO called the accusation that Nvidia's investment somehow props up the whole business ridiculous, pointing out that Nvidia's stake is far too small to actually be propping anything up. Asset managers like Janus Henderson describe the whole arrangement not as financial engineering, but as a virtuous circle, a practical way to line up suppliers, builders, and customers fast enough to meet genuinely exploding demand for computing power. And there's a real argument behind that. The most advanced AI chips are still scarce and expensive, so locking in long-term supply with financing attached isn't unusual. It's how you secure access in a market where everyone's fighting over the same limited hardware. But instead of de-risking, the system just kept adding more leverage on top. In August, Nvidia announced new financing platforms with some of the biggest names in finance: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, creating debt vehicles collateralized by Nvidia's own chips, specifically to lease out more compute to Nvidia's own customers. That's not reducing the circularity. That's Wall Street's biggest lenders climbing into the same loop. Here's the number that actually matters for where this goes next. Analysts at Bain estimate the AI industry needs to close a revenue shortfall of hundreds of billions of dollars by the end of the decade just to justify the capital spending that's already been committed. If real end-user demand for AI keeps compounding the way it has, this entire web of deals turns out to be smart, aggressive vertical integration, the exact kind of infrastructure bet that made previous tech booms pay off massively for early movers. If it doesn't, this becomes the most well-documented, cross-referenced bubble in financial history, one where every single participant could see the whole structure and built it anyway. The honest answer is, nobody knows which one it is yet. But every dollar in the stock market right now is quietly betting on the first outcome.